There's $56 trillion sitting in pension funds right now. That's more than the GDP of the United States and China combined. And most of it belongs to people who have no idea what it's doing. Firefighters, teachers, nurses, office workers who stopped thinking about their retirement account years ago. But that money, it's everywhere. When Tesla's stock jumps 10% in a day, pension funds are there. When a Silicon Valley startup gets a billion-dollar valuation, pension funds wrote the check. When a government needs to borrow money to keep the lights on, pension funds buy the bonds. They own stakes in nearly every major corporation on Earth. They finance entire countries, and almost none of it is by choice. Here's what happened. 50 years ago, if you worked for a company, you got a pension. Simple deal. Work for 30 years, retire, get a check every month until you die. The company figured out the math and set aside the money. Then, in the 1980s, corporations realized something. Pensions are expensive. They're also unpredictable. People keep living longer. Markets go up and down. So they offered a new deal. Instead of promising you a specific income, they'd give you a 401k. You put money in, they match some of it, you invest it yourself. Whatever it grows to, that's your retirement. The risk just moved from them to you. But public sector workers, unions, and some large companies kept the old system. So now you've got these massive pension funds managing trillions on behalf of millions of people who need that money in 20 or 30 years. And here's the problem. They made promises based on math that doesn't work anymore. Most pension funds assume they'll earn 7% returns every year. That's how they calculate whether they have enough money to pay everyone. But to hit 7% consistently, they can't just buy safe government bonds anymore. Those pay 4%, maybe 5%. So they go hunting. They buy stocks, billions of dollars into Apple, Microsoft, Nvidia. They buy real estate, shopping malls, apartment buildings, office towers in cities where nobody works in offices anymore. They fund private equity deals, leveraged buyouts of grocery chains and hospital networks. They back venture capital firms betting on companies that don't make profit yet and might never. They buy infrastructure, toll roads, airports, water systems. And because they're so big, they move markets. When California's state pension fund decides to buy, prices go up. When they sell, whole sectors feel it. Here's the irony. The system designed to protect workers in retirement is now one of the biggest forces pushing companies to maximize short-term profit. Pension funds need returns, so they pressure corporations to cut costs, buy back stock, hit earnings targets every quarter. The same workers whose pensions depend on those returns end up losing jobs or benefits because the fund that's supposed to protect them demanded efficiency. It's a feedback loop that doesn't resolve. And the math still doesn't work. Most state pension funds in the US are underfunded. They have about 75 cents for every dollar they owe. Some have less, which means they take bigger risks, more private equity, more leverage, more bets on things that might pay off huge or might disappear. They're not trying to be reckless. They're trying to keep a promise someone made 40 years ago with money that doesn't exist yet. So the next time markets jump or crash for no obvious reason, check who's buying and selling. It might just be your retirement, whether you know it or not.